Welcome to Industry Focus,
the podcast
that dives into a different sector of the stock market each day.
I'm your host, Emily Flippen.
I'm Jason Moser.
I'm Nick Seipel.
I'm Dylan Lewis.
And today we're talking financials.
Today we're talking consumer goods.
Wild Card Wednesday.
And we're talking energy.
And today we're talking tech.
Let's dive in.
Welcome to Industry Focus. I'm Nick Seipel. This week, I'm excited to welcome back Tracy Schuchart to the podcast. Tracy is an expert on the energy and commodities markets with prior experience at the Chicago Board of Trade, among other finance roles. Today, she manages an energy and commodities portfolio for Family Office and publishes a newsletter on the energy sector, in addition to being an incredible follow on Twitter with her Shy Girl Twitter account. Tracy, welcome back on the podcast.
Great. Thanks for having me.
Great to have you back. Before you hopped on before we started recording, I was just talking about it's been a while since the last time you came on the podcast. The last time you came on, February 6th, 2020, oil was around $50 a barrel at the time. We just had flights from China being banned, but nobody was talking about shutting down the economy, and we definitely weren't talking about all the craziness that we've seen in the macro economy over the past year and a half or so. So, as someone who pays attention to the macro, what's it been like just the past year and a half or so?
Well, obviously very crazy, right? I mean, first we saw negative $37 oil. Who would have ever thought that would be possible, right? And now we're, over $100 above that. So quite the move in just a little over a year. So that market's, seen a lot of action. And obviously we saw stocks at their lows to making all new highs. So it's been a wild year.
Yeah, one of the big themes we were talking about at that time was that, even before the pandemic, there was this big, huge wall of debt coming due for folks in the shale industry. And last year in 2020, we saw a record year when it came to shale bankruptcies. Today, we're seeing the market where, $70 oil, that starts to look kind of interesting. So what do you make of just the current state of, U.S. oil and gas production and these shale players after you go from bankruptcy to now, maybe producing some cash flow?
Right. Well, I think they're obviously in a much better position than they actually have been since 2016, really. But I think that they're also going to be a little bit more cost effective. They're going to be a little bit more conservative in the market. I don't think they're going to go crazy. And you also have to look at the opposite end. The easy money is gone from the oil industry, right? So with the onset of ESG guidance and whatnot with the banks, they are not looking to fund oil and coal projects anymore. So financing is going to be difficult for these guys. So I don't think that, we're going to see at $70 in oil, them go, crazy and open up the production taps like they were, just because they just simply won't get funding.
Which, from our perspective, is great as investors, right? Because really, there's too much capital flowing to this industry. Shale worked too well and really kind of upset the apple cart. You've seen OPEC, try to get things underway, and maybe we'll talk about the ESG stuff here in a minute. Another theme we saw coming out of 2020 is Russia kind of getting on board with the OPEC program, and so in addition to the kind of shale, maybe being forcibly made to be a little bit more disciplined, you've had the OPEC folks really get on board in a significant way. How do you think the geopolitical landscape has changed over this period?
Yeah, well, we saw, I think, after negative oil, after Saudi turned on the taps and then we had negative oil, all of a sudden, I think that shocked the market so much that we started to see a very different OPEC plus alliance, right? And we started to see them being much more cohesive group and adhering to quotas for the very first time in years. And that strategy's paid off in spades. So I think that will, that obviously will continue. With this new administration, we're starting to see some tensions in the Middle East again. So, that's always, kind of a worry again. For right now, we obviously have this Iran deal hanging over, which in all actuality, they're already producing like 2.5 million barrels a day. They can probably tap out at 4, so that's like 1.5 million barrels, and the market could actually definitely handle that. And OPEC is completely aware of that. If that production should come back online, they will adjust their figures accordingly. In addition, I think that this deal is going to take much, much longer than people think, just because of all the opposition that there is in Congress. Even though we don't have to get congressional approval, Congress is still can put it up to a vote to make the executive branch get approval. So there's a lot going on behind the scenes, aside from all the headlines. So, I'm of the opinion that it's really going to take a lot longer than most people think. But should it happen, the market actually can handle that right now.
Yes, so there's been some production offline. Just kind of fill in the backstory for folks with kind of controversies with Iran. To the extent those tensions are lifted and there's no more sanctions in place, that's a lot of oil potentially coming onto the market. Now you could say maybe not all of that was off the market during this period either, but we'll come into the white side of the market, off of the black market, perhaps. So when you look at maybe shale getting their discipline together, OPEC, maybe being more constructive, should we be expecting oil to be in this $70 range? Do you think this is a market that's constructive for the oil stocks for maybe the first time in a long time?
Yeah, absolutely. I do. I mean, I think they're going to be, very, I think they're going to be, they're hyper aware that this strategy is paying off, right? So they might not be exporting as much, but they're making more money because the price is higher. And I think that somehow clicked in their minds, that this is actually working better for them. And so I think that will continue. So I think, if we stay in this, between Brent's a little bit higher. So if we stay in this, 70 to $80 range, I think that, then we'll see oil stocks hold up, right? Except for today, because bonds are killing everything.
Yeah, well, let's talk about that. So today, oil down about 3%. I think right before we hopped on here, there was the Fed news, which has been constructive for the dollar. What do you think about the macro and what's going on there and how it's affecting the dollar, oil, all this?
Right. I mean, well, I think that definitely oil needed a pullback, and it's also options expiration. So there's a lot of factors, and roll right now. So there's a lot of factors involved, but it's kind of very stretched. Actually, all the markets were kind of stretched. The dollar was oversold, bonds were very oversold. So this kind of seems like a slingshot move, because the Fed wasn't really hawkish at all, right? I mean, 2023 is a maybe. We're kind of talking. I mean, it wasn't really hawkish. This just feels like kind of a snapback move in markets that were to one extreme or another.
Got it. So don't overreact too much to what's going on with the Fed from a macro perspective today.
No, right. Yeah.
Is generally the answer.
Yeah. I mean, it's status quo right now, right? Their taps are on.
Right. So you mentioned, all right, so we're in this period for the first time in a long time where oil prices are constructive for these companies, but at the same time, we're seeing these ESG pressures saying, hey, we don't want you producing oil and gas. So there's this little bit tension, right? So the economic conditions are strong, but the shareholder maybe conditions not as strong. How do you see ESG affecting the oil and gas market these next few years? What's going on here?
I mean, I think that oil's got, I'm vested for the long term, right? So long term meaning, next 10 years out, at least for the next decade, we're set to see oil growth, right? In all of the projections, especially coming out of Asia and Africa. So, I mean, those markets are going to still continue to grow. Emerging markets can't fund ESG projects, the way, even with help from the IMF or from other countries. So I think this process is going to take a lot longer, even though we're seeing bigger pressures in the West. I still think the oil and gas industry is very strong in other parts of the world, and will continue to be, strong here. I mean, we're still consuming 19.3 million barrels a day in the United States, the most of any country in the world. So, that's not going away anytime soon. And and it's a contrarian bet, but I mean, if you look at ESG stocks, right? I mean, pretty much for the last 6 months, all they've done is gone down, right? If you look at like TAN, the solar ETF, or any of the hydrogen stocks and things like that, they really haven't taken off, even though we've had this huge ESG push kind of in the media.
Yes. So do you think So when you say, demand you expect to be strong and perhaps growing over the next decade, it's kind of this U.S. centric story to this idea, or maybe Western economy centric story to the idea of transitioning. So do you think that the whole energy transition narrative is more narrative than substance?
I mean, right now I do. I mean, and I'm not saying that to be, I mean, I think ESG is great. I think it's great if we, have cleaner sources of energy and things like that. But taking that, my personal thought about that aside, and looking for at an investment standpoint, right? Because I cover ESG too. Looking at an investment standpoint, I just think there's more opportunity, probably because it's so hated. And you have to look at the market; it's been beaten up so much. I mean, it went from 20% of the S&P to like 2% of the weighting. I mean, everything's 80% off right now. I mean, that's kind of enticing as an investor.
Right. Well, yeah. When you have bunches of people out there saying this industry is going away, and you look at the numbers that saying this industry is still gonna be around. Another thing that we can talk about is a lot of the biggest players in the industry getting the largest pressure to reduce their oil and gas production. So you mentioned this being kind of a Western story. I think the Europeans are really where you're seeing the largest pressure. BP saying, "Hey, we're not an oil and gas company anymore. We're an energy company." You've got this pressure from Shell. So you talk about what's going on in Europe, and they seem to be at this just accelerated pace of the ESG pressure than we're seeing anywhere else in the world.
They do. I mean, it's really, it's Germany centric, really. I mean, they kind of really had that big push or the country that had the big push in Europe, right? But if you look at, and they're probably more integrated than a lot of countries. Spain too, a lot of Western European countries, are probably are a lot further ahead than the United States, or say, but they're also having energy issues, right? So, energy prices are the highest. Just yesterday, prices are the highest in Spain that they've been in years. And most of they have some gas, but it's mostly nuclear, solar, and wind. Last year, there was a hot summer, and Germany had energy problems. So the thing is that there needs to be like a transition, and it's not a smooth transition, and you're going to have problems, just like, just like we saw in Texas. I mean, you need to have a mix. You need to have an energy mix, right? You need a transition fuel, which is gas, which is interesting because the EU, the new Green Deal, they just decided to go, they would go ahead and add natural gas back into their plan that is okay energy source, because I think they realize it's cheap, it's abundant, and it's a good transition fuel.
Right. I mean, Russia is one of the largest producers of gas in the world. You've got the Nord Stream pipeline going on over there that's been very geopolitically charged. There's been gas shortages over in that part of the world. So you see, even despite some of these ESG issues, sooner or later something's got to give with kind of that pipeline and kind of gas production to that part of the world.
Yeah, absolutely.
So we talked about Europe a little bit. In North America, we've also got kind of activism going on. What do you make of what's going on with Exxon? So Exxon for the longest time has kind of stuck to their guns with investing in oil production. And then you've had this push in from engine number one, and they really didn't buy a massive amount of stock, but they did gain some board seats. What do you see going on here, and what do you make of Exxon?
I mean, I think it's going to be, I really liked Exxon just because they were the only major to kind of stick with their plan of being an oil company and not being like an integrated energy company. I mean, Engine One got 2 seats. I think we'll need to wait and see. I mean, there is always a chance you could see some upset there. So it is, something I'm watching very carefully, but I don't know how much 2 seats will actually do. But, we'll keep an eye on that. But it's certainly, it's certainly interesting, and that only kind of makes me more bullish the sector of sort of the the lower tier, middle to lower tier companies and frackers in the U.S.
Right. So that raises the follow-up question, right? So we're in this world where lots of this activist pressure, ESG pressure on the big oil companies. You think of the big oil companies being the most sophisticated operators, the ones that, maybe have the lowest break evens, that sort of thing. You push these people out of the market. There's still going to be demand for oil and gas, as you said earlier. who benefits? Do you think, is it these small oil producers? Is it, Russia and Saudi Arabia? What do you think happens?
Well, I think I think it's going to be both, like, because, we have oil flows, right? Russia and Saudi Arabia produce very different oil. Russia produces heavy oil. Saudi Arabia is kind of medium oil. And US is very light oil. So there's a market for all of those oils. So there's, definitely a market for the US. And, in 2015, we just became an exporter. So, so I definitely think that this environment that they're creating with the majors is going to be very beneficial for, some of these smaller fracking companies in the United States.
Yeah. So another topic. So for you may not know this, but our listeners of the podcast know this. I've recently joined the Full Canada team, so I've been paying attention to some of the goings on in that country. You see, some of the Canadian oil stocks also have been bombed out somewhat, and there's a little bit different environment maybe in that country around oil production than you see from the majors in the U.S. What do you make of their positioning? That's another subsector that the Canadian oil sands folks that they haven't received a lot of love for a long time, but the market is coming to where things could be supportive for them.
Yeah, I definitely think the market is starting to be and yes, oil sands have been hated for much longer than than the frackers have. But there's definitely a market for their oil, and what is left of their production, if the government hasn't totally shut it down. I think that the companies still remaining there will be very beneficial, because there is a very big market for that. And if they could capture the Chinese market, right? If they could get a extra pipeline capacity built to the West Coast, they could also sell to China, whereas most of their oil goes to the United States.
I mean, that's another scenario we've seen over the past, couple of years. Really, really difficult to build pipeline capacity, whether it's the Keystone XL pipeline or, we've seen some more consolidation in that space. Do you think we need more pipeline construction to, stimulate the oil market, or is that not important?
I think Keystone XL was a big mistake, right? Because it affects two countries. Not only the United States, it affects Canada as well, because they can't get their oil now to the East Coast. Right? And I think that project also is, I think by that project getting canceled, that could throw a little bit of a wrench in the Canada-U.S. relations. So when other issues come up, such as the U.S. Likes to go after the Canadian dairy industry, I think that Canada will put their foot down there a lot more. So kind of look at other commodities. Trade between the two countries, I think, could be affected, because Canada was very upset about that project being canceled.
That is kind of the thing that this all comes back to at some point or another. There's so much international trade going on here, the geopolitics going on in these economies. So before we move on from oil, so you mentioned kind of small frackers. Are there any names that come out to you, as these are the folks that I consider, on the short list of primary beneficiaries?
Yeah, I really like Devon Energy. I've liked them kind of for a while. And I like Schlumberger for services. What else am I looking at? I can't think what I have on my when I'm in the top. I'm not at my computer right now. Or if you want an ETF, if you look at something like OIH, that's just starting to break out of a multi-year descending wedge. So if you prefer to play an ETF in a basket or something like that, I think services will do extremely well.
Yeah, well, so do you think that's just like production coming online to kind of meet this commodity? Because I think services has been another area that has been in a really tough spot. Part of what's brought break evens lower is service prices that have come down so much. So you see, servicers being a shortage of servicers at some time in the next few years?
I think what's going to happen, the U.S. is going to, if we look at the curve right now, this is a very tight market, believe it or not, right? You have backwardation exploding. The back end kind of came in about $1 or so, that ZZ spread kind of came in about $1 or so today. But if you look at like UZ, it's still exploding higher. So backwardation is still very prevalent in this market and getting more backwardated. That means that, in the future, we're looking at a supply problem. So they are going to have to bring on, more supply, even though I think it's going to be difficult for them to get funding. So, services will definitely, will be needed as they have to bring on more production.
Absolutely. So we've spent a lot of time here on oil and gas, and I think there's lots to talk about here. I know you do follow some other areas of the macro economy. One of the big themes so far, for the year has been inflation. You've seen explosions in things like used car prices or lumber for a while, although lumber's cooling back off. Metals. What are some things standing out to you in those areas?
Well, I think long term, especially if you're really looking at base metals, I'm very bullish base metals long term. Again, we've seen a pullback here on the technical side. It was very, very overbought, and then you also had China come in and say we're going to release from our SPR, but for metals, so that because they're trying to control prices, but it's very uneven. Say, we're seeing a pullback in nickel over there, but stainless steel, for example, is still moving higher. So, I think China's trying to control the market and control commodity prices, but I don't think that they're going to be able to do that, because if we look forward and, if we want to meet all these demands for, say, for electric vehicles and things like that, then we're going to need a lot of these base metals, and we simply don't have it. The problem is that it's not China. China can't control the price if really the world's undersupplied.
Right. So I think one of the big themes we've talked about so far, then, that's kind of emerging is, number one, there's the narrative of oil's getting replaced by these other energy sources. However, if you look at demand, still going to need oil. Also, to the extent oil is going to be replaced by some of these energy sources, we need a lot of these other metals and commodities and things like that. So, across the board, it sounds like, commodities need to move higher.
Yeah. I mean, that's really what I'm looking at over the long term, and I look at it, I'm not looking at it, the day-to-day moves when I make those decisions. So, a lot of people are like, are you still bullish after today? We came down 3%. Yes, I'm still bullish after. Over the long term, yes, because we have all these ESG goals, we have all these, look at all the EV, look at all the car companies that are coming out with new electric vehicles, and we just simply don't have the supply. So, I like miners, things like Vail or Cleveland Cliffs, which is just a metal supplier. So those are kind of some of the companies that I'm looking to for base metals.
Yeah, no, that makes a lot of sense. As the economy rebounds and we try to restart some of this production, and everybody wants houses and all these sorts of things, you need to produce these things. And also, there's been massive underinvestment in the sector if you look back over the last decade, and that bill is coming due.
Yeah, absolutely. So, the commodity sector I think it's going to be, remain strong over, the next 5-10 years, at the very least, for certain. Just because of everything that's happening. The transition is going to require that. And, as far as the oil and gas, like we said before, demand is still set to grow for out to the next 10 years. So.
Yeah, well, and those mines need backhoes and all those things. Those mines need energy supply too to make those things happen. So it takes some investment. So we've talked about this kind of theme emerging, kind of bring things together. What are, as you look out over the next, say, 18 months, right? So maybe the next time you come on, the next 18 months, what are some themes that we should be paying attention to in the macro economy and this kind of oil, gas, commodities universe?
Well, I think, obviously inflation is going to be the big thing, right? Is it transitory? Do we, I think the Fed obviously is, expressed a little bit of concern, but, I think that really, they said they would let it run hot. So, I kind of believe, and I think Yellen came out today and said, we're not worried about hyperinflation, which makes me worry about hyperinflation.
Looking where the bodies are buried, right?
Right. But so, I think that's going to be a big play, right? And then obviously, is the Fed going to taper or not? Not. I think they're going to talk about it and think about talking about it and then talk about it some more and then probably push that off and then talk about it again. So I really don't see that happening unless, in 2023, unless it's maybe a one and done. But, I think they're going to fear kind of a repeat of the 2018, right? When they tried to taper and tried to raise rates and quickly had to reverse that.
Yeah. So yeah, the Fed certainly something to watch. Another theme that we've seen kind of emerging, right? I can't tell you the number of times in the past week or so I've seen the phrase super cycle and seen the phrase $100 oil. What do you
Yes.
think? Do you think that's hype, or do you think there's a real story there?
I do think we'll see kind of a commodity super cycle, only being in the fact that we're going to need so much more, right? And it's expensive, it's energy intensive to mine all of these things. $100 oil, if we even got there, I think it would be so brief, right? Because I think OPEC and everybody is going to try as best as they can to keep it in that $70-$80 range. So, I don't think we're going to see $100 oil this year. I could be wrong. But I'm of the opinion that we probably will not see that. And I think everybody's pretty comfortable at, that $70-$80 range. So, we've moved up so much and so quickly, it wouldn't shock me if we kind of were sideways market for a while.
Yeah, that makes sense. And I think as a consumer, we don't really want crazy volatility in the oil markets. We saw crazy volatility last year. We saw crazy volatility with this craziness with the pipeline. I think it makes things challenging. If we've got OPEC, pushing oil prices up to $100, that maybe is a world that wouldn't be as fun to live in. Who knows?
Yeah, I mean, I don't think that they want that either, because that really hurts emerging markets. Places like India, Africa, they can't really handle paying those prices. So, they're trying their best to keep it where, people are making money and emerging markets aren't blowing out.
Awesome. Well, Tracy, thank you so much for joining me. Always love having you on to talk about kind of the macro economy, what's going on in oil and gas. Great to get your perspective. If folks want to keep up with the work that you're doing, where can they find you? Where can they see your work?
So I'm on Twitter at Chigirl, CHIGRL. And then also I write for hedge fund telemetry. And if you want, you can go on there, but you can get a free 2-week trial, and you can also read everything that I've written since
forever. So awesome, Tracy. I'll throw a link in there in the description of the podcast, and can't wait to have you back on again soon.
Yeah, absolutely. Thanks.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Tim Sparks for mixing the show. For Tracy Schuchart, I'm Nick Seipel. Thanks for listening, and Fool on.